Ladies and gentlemen, good day and welcome to the Hindustan Foods Limited Q3 and 9 months FY22 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Kothari, Managing Director, Hindustan Foods Limited. Thank you, and over to you, sir.
Thank you, Rutuja. Good evening and welcome everyone to our quarterly earnings conference call. I hope all of you are doing well. I am joined on the call by our Executive Director, Mr. Ganesh Argekar, our CFO, Mayank Samdani, our Company Secretary, Mr. Bankim Purohit, and Vimal Solanki, who is the head of our corporate communications. In addition to that, I am also joined by SGA, who is our investor relations advisor. I hope everyone has had a chance to go through our updated investor presentation. We did spend a lot of time on that presentation this time, basically to explain the rationale of our mergers and acquisitions. I am quite pleased with the performance of the company in this quarter. We have achieved the highest ever profit and the highest ever turnover in the history of the company. However, due to some accounting quirk, which Mayank will explain, the PAT of the company is not exactly comparable to the last year's figure, and as a result, the growth in the PAT looks deceivingly low. As I mentioned in the investor presentation, for me personally, this quarter has been very interesting from the perspective of mergers and acquisitions. As you are aware, and at least some of the people who have been looking at our company would be aware, we've been quite active in the M&A space and have tried to be optimal in terms of our capital allocation to acquisitions. In the last quarter, we had announced our intention to get into the space of OTC healthcare and color cosmetics. And accordingly, the board had authorized us to invest in both of these sectors. The reasoning of getting into these two sectors in particular was discussed in the last call as well. Based on this, we've actually announced two acquisitions, one that of Reckitt Benckiser Scholl and the other of Aerocare Personal Products. The first is a company, that Reckitt Benckiser Scholl is a company that is engaged in the manufacturing and export of foot care products under the brand of Scholl. And it is an MHRA approved, which means MHRA UK approved site located in Chennai. For those who are familiar with our business models, this is going to be an anchor tenant factory with nearly 50% of our capacity, which has been earmarked for the existing business of Scholl. As management, we will try to leverage the excess capacity to attract businesses from other brands and also increase the wallet share of the existing customer. The second factory that we've acquired is that of color cosmetics. Aerocare Personal Products is engaged in the business of manufacturing color cosmetics for a leading brand. This is a dedicated factory, and we have a take-or-pay contract for the next 7 years. We are confident that we should be able to run this factory as efficiently like we do in case of our other dedicated factories, especially since we have a base in Silvassa and we have factories that make Harpic and Lysol. So we believe that having existing management in that location will make this integration far more easier. Including the other projects that Mayank and Ganesh will update you about, I am confident that we should be able to achieve our target of 2,000 crores for this year and are working very hard towards our turnover of 4,000 crores that we have planned for FY25. I will now hand over the call to Mayank, our Group CFO, who will take you through the financial numbers, and then Ganesh will brief you about some of the new projects.
Hi, good afternoon everyone, and welcome to our Q3 and 9-month FY22 earning call. I hope each and every one of you is safe and healthy. Overall operational performance for the third quarter and the 9 months of FY22 has been in line with the company's internal target. Our total revenue of the quarter increased by 36.2% on YOY basis to rupees 523 crores in Q3 FY22 as compared to 384 crores in Q3 FY21. EBITDA for the quarter has seen the growth of 34.5% year on year and stood at rupees 30.14 crores as against rupees 22.41 crores in Q3 FY21. For the 9 months of FY22, our revenues increased by 60% to 1448 crores as against 905 crores in 9 months FY21. EBITDA for the 9 months FY22 stood at 85.3 crores, which is higher by about 43% on year-to-year basis. Profit before tax grew by 48% year on year to 19.5 crores, which is the highest ever reported by the company. While the PBT was higher by 48%, our PAT growth of 1.2% year on year for the quarter was just not strictly comparable to the last year, as the PAT includes excess provision of tax to the tune of 3.86 crores in FY20, which was reversed in Q3 FY21 after filing the tax return. 9-month PAT stood at 35.3 crores, which is increased by 40% and truly reflects the growth compared to the last year. The Honorable NCLT Mumbai Bench, in its hearing held on 21st December 2021 in the matter of the composite scheme of arrangement and amalgamation of the beverage plant at Mysuru and the malt beverage plant at Coimbatore, has passed the necessary order. The appointed date is 1st April 2020. The composite scheme is expected to be effective from Q4 FY22. We reiterate our near-term and the long-term targets for revenue and profitability as we continue to focus on the accelerating growth through exploring organic and inorganic opportunities. With this, I hand over the call to Mr. Ganesh Argekar, who will talk about the operational performance of the quarter.
Thank you, Mayank, and good evening to all participants. In terms of operational performance, recently commissioned Silvassa facilities have been ramped up well and contributing to the revenues meaningfully. The Uttar Pradesh ice cream project is progressing well and installation of machines has commenced. The company remains confident to start commercial production in Q4 22. However, the Hyderabad project has been delayed and it is now expected to complete it only by Q2 FY23. Work on setting up a new shoe factory in Tamil Nadu is progressing well. The factory will be making sports shoes, knitted shoes for various customers, and we expect to start production in Q1 FY23. HFL has acquired 100% stake in Reckitt Benckiser Shawl India, which marks HFL's entry into the fast-growing OTC healthcare and wellness segment as a contract manufacturer. The acquired facility is registered as an export-oriented unit and approved by the Medicines and the Healthcare Product Regulatory Agency, MHRA, UK. It is currently exporting to more than 20 countries. HFL is expected to leverage the potential by expanding site utilization and capacities and thus increase the share of business for its products worldwide from this site. The company expects to do around a turnover of 100 crores from this facility in 2023. I am also happy to announce that the company is invested in Aerocare Personal Product LLP. Aerocare is currently manufacturing various color cosmetics like lipsticks, eye makeup, pressed powders, lip gloss, and also oral care and aftershaves. The company expects to do around 100 crores also from this facility in 2023. With this, I would like to open the floor for questions. Thank you.
Thank you very much. So we'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Samir, congratulations for having achieved the highest ever sales. My question is more towards the excess land that we have in our various facilities. Is there any thinking to really go very quickly on to monetizing them through any warehousing or kind of selling it off? And secondly, you said that you will double your sales by 2025. So are we on record saying that we will not expand equity till then?
Good evening, Faisal. Thank you. I think there are two questions, and let me try and address both. As you rightly identified, we do have a lot of excess land bank across all our factories. The current plan for unlocking that land bank continues to be expansion in our existing business, which is growing the contract manufacturing of FMCG. As you know, the consumption story in India continues to be bullish. And as a result, we will get inquiries for brownfield projects, expansion in the site, etc. And that's what we are doing. If you look at our Hyderabad experience, we bought the factory, we bought the land in nearly 10 years ago. And since then, we've expanded the factory 3 times over. So as a result, the current plan for monetizing the excess land is to continue doing what we are doing, which is contract manufacturing. At some point of time, and it's too much in the future for me to even talk about it, we will look at other ways of monetizing that excess land, whether it's in the space of warehousing or in terms of anything else. Your second question was...
equity expansion.
Yes. Okay. So, Faisal, in terms of our equity fundraise, I just want to reiterate that it's too early to kind of give you specific details. I think we tried to address this question last time, and last time we didn't have clarity about these 2 acquisitions. All I can tell you is for all the acquisitions and the expansions that we have currently announced, we are well funded. We don't need to raise money for this. There's a bunch of things which is always in the pipeline, and it's too early for me to give you any kind of details about what will happen, which of those projects. All I can assure you is that if we get to a situation where new projects, new acquisitions come online, we will definitely optimize the capital structure in terms of debt and equity before we hit the equity market.
So we will definitely be able to double the quantity sales or the volume sales in each of these factories with the existing extra land that we have?
Okay, wait, I'm not sure. Faisal, I'm not sure when you're saying that double the turnover of each of these factories, we basically have put ourselves a target of doubling the turnover of the company, which is going from 2,000 crores now to around 4,000 crores by FY25. For that, the way things are looking, and based on we've tried to highlight what is the expected turnover from these acquisitions in the next financial year, etc. I think we have clear visibility of doing a turnover of around 3,000 odd crores next year. And beyond that, I think it's really too early for me to tell you how we're going to make a journey from 3,000 crores to 4,000 crores.
Okay, thank you so much.
Sure.
Thank you. The next question is from the line of Priyanka Singh from Atidan Securities. Please go ahead.
Thank you for the opportunity. Firstly, as the Hyderabad project is getting delayed because of ongoing softness in demand, out of 150 crore capex for this project, how much capex is still remaining as it has been getting delayed? And is there any cost overrun because of the delay in commissioning?
Okay. Hi, Priyanka. Priyanka, just for me to spend a minute, and I can't give you specific details, but let me just explain to you the way we work on projects. All our projects are earmarked, budgeted with our principals. Right from day one, the entire timeline as well as the budget is approved by our principals. Any cost overruns which happen during the course of these timelines are passed on to our principals unless these cost overruns are due to our inefficiency. If they are due to inflationary conditions, if they are due to changes in macro environment, etc., they generally get passed on to the customer. In terms of the delay in case of this project is not due to any fault of ours. I think it's overall just in terms of the demand-supply situation of our principals that we've been asked to go slow. So as a result, I can confidently tell you that the company will not be suffering any cost overruns or for that matter any penalties for the delay in this project.
Okay. And how has been the ramping up of new Silvassa facilities? Like what are the utilization levels at these facilities?
Priyanka, both facilities, like Ganesh was mentioning in his opening remarks, both the Harpic and the Lysol facility have ramped up from an operational perspective to their maximum capacity. However, based on the demand, we still have some leeway in terms of head space. But again, if you're familiar with our business model, since they are dedicated factories, once we have achieved our ramp up, the actual month-to-month or day-to-day capacity utilization actually does not affect us.
Okay. And lastly, for your health and wellness segment, as you have approval of 100 crore investments from board, are you looking for investing the remaining 25 crore in this segment as the acquisition cost for Concall India was about 75 crores?
Priyanka, yes, you're absolutely right. I think we do have some headspace there. And yes, we continue to evaluate both organic as well as inorganic expansion even in that space. Too early for me to give you any details, but hopefully in the next couple of quarters we should be able to come back to you and tell you what we did with that extra leeway that we have in terms of the investment amount.
Okay, very helpful. Thank you.
Thank you, Priyanka.
Thank you. Ladies and gentlemen who wishes to ask a question, please press star and 1. The next question is from the line of Akash Zaveri from Perpetual Investment Advisors. Please go ahead.
Hi, Mr. Kothari, and firstly, congratulations on a great set of numbers, and also regarding the M&A for this quarter as well as your previous M&As. It's great to see that all the acquisitions have turned around and now they're doing well. My first question was regarding the Aerocare. It seems like a very good deal, valuation-wise, cheap valuations for 30 crores are getting a plant which will give about 100 crores turnover in the first year of operation. And so this plant was set up just a year ago. So just wanted to understand how did we, manage to get such a good deal from this plant? If you could just throw some light on that.
Sure. Akash, so good, bad is a relative term. Broadly, I can explain the difference between the two acquisitions that have happened, and given that both of them we expect to do a similar turnover, I'm sure it raises some doubts in terms of why is one costing so much higher than the other. The second one, the one that you're referring to, which is Aerocare, frankly, the land and building is leased. And as a result, we have not acquired the land and building. What we have acquired is basically the plant and machinery. We've acquired the leasehold rights for the next 7 years. And of course, we've acquired the working capital. In case of the Chennai facility, we have acquired the 8 acres of land in Sriperumbudur, in addition to a building which is Class A because it conforms with all the medical requirement, the drug requirement of US MHRA approval from UK, etc. And of course, the working capital situation for both of these companies was completely different because one of them, which is the shawl one, caters to an export business. And as a result, the working capital investment there is much higher as compared to the one in Aerocare. So I know it's very in your face and very natural for anyone to compare two acquisitions, same quarter, same amount of turnover, why the difference in valuation. But if you drill down into the specifics, the difference in the valuation comes because of the land and building, and it comes because of the nature of business.
Got it. So the IRR for both the deals would be similar, or what would be the IRR for both these deals?
The IRR should be similar, and I would like to be carefully optimistic that the pharma business should hopefully earn us better monies than the personal care business.
Got it. And the plant the capacity is 3,500 metric tons. So what will be the current capacity utilization of the plant?
You're talking of the Silvassa facility.
Yes.
The Silvassa facility, Akash, again, is a dedicated facility. It's fully ramped up. And as a result, we expect, and that's why we've given some clear indication of the kind of turnover we expect from it next year. In terms of capacity utilization, like I said before, in case of dedicated factories, it actually does not make too much of a difference.
Yeah. Got it. And the land bank, is it completely used, or is there any scope for expansion in the land bank for the AeroCare deal?
So in case of AeroCare, and I'm just reiterating, the land and the building are leased.
Oh yeah, sorry. Oh yeah, got it.
Physically, there is some amount of space available there, which we are hoping that we'll be able to do something with it.
Okay, and the margins in this plant would be similar to the rest of the business, or would it be more or less?
You're talking of margins with a denominator of sales?
Yeah, as a denominator of sales.
So I'll let Mayank answer this question.
So Akash, because this is also a dedicated factory, AeroCare, the margins will be in line with our current dedicated units.
And the return on capital?
Will be the same, because the dedicated factory, the logic remains same where it is, if it is any factory, any product.
Got it. Okay, fine. Okay. And coming to the Scholl deal, so now that Scholl is reunited back with Dr. Scholl, so does it open any new doors like US for this plant, or and the 100 crore guidance that you've given for the next year, would that be only for 50% of the plant, and for the other 50, as you said, we're going to leverage that excess capacity? So is that 100 just for 50%, or is 100 the overall what we're expecting from probably new customers for that plant?
Akash, I have to compliment you. I am very impressed. You are absolutely right that the Scholl business has been taken over both for the Americas and the rest of the world by one company. Frankly, we are hopeful about some synergies which will come in because of this consolidation of brands which has happened. Currently, we do not have any visibility in terms of that, and as a result, the guidance that we have given is only for the business that we have visibility on.
Got it. So for Q4, like the current quarter which is going on, so would Aero and Scholl both be consolidated in our overall business numbers?
For Q4, frankly, I'll let Mayank discuss it, because there's a lot of legal formalities that he has to do. So go ahead.
So yeah, Akash, there is certain formalities of name change and land name change which is going on. As you have, we have also mentioned that the closing date will be a later date, which we also don't know right now. So we are not very sure that what will come in Q4 and what will not come in Q4. But we are very sure that both of the deals will be closed before the Q4 of this year.
Okay, perfect. Thank you so much. And ma'am, the next question was, what will be the debts as on 31st of December?
31st of December, we have a debt of 240 crores.
240 crores. And just regarding the previous question, the ROC to expect from the Scholl deal would again be similar to our current business? Or would that be a little more on, since it's pharma, would that be a little more?
So 2 points to it. The current ROC will be slightly higher because it's a pharma business. Secondly, based on the consolidation, etc., if we are actually able to see some benefits flowing to us in terms of becoming a global supplier to Scholl / Dr. Scholl, then we think that the ROC could get very, very interesting.
Got it. The next question was the ice cream plant, which is going to get commercialized in this quarter. So how does the demand look, for that plant? And would it start probably in the first initial weeks of March, or just before the quarter gets over? I'm asking this so how much of the revenue would flow in the Q4 numbers. So that was, and how does the demand look?
So Akash, frankly, the in the Q4 of this financial year, I would be very, very surprised if the ice cream factory actually contributes in a significant way to the turnovers, because what we will start off with is trial production, and it will take nearly a month or so to ramp up. The demand is looking very good. It's the main season of ice creams, as you can imagine. In addition to that, it is also the main in terms of the location, we are in Lucknow, which is a very interesting market for our far as ice creams is concerned. So the demand is looking good from a number. I would say give it the middle of Q1 of FY23 for it to really start delivering its stated numbers.
Okay, got it. Thank you so much for that. So the next question was, the loss from our associate is now almost, you can say it's break even, and I can imagine how happy you would be, for that. So can we assume that ATC would now become profitable from here on, since Q4 and Q1 would be peak season? And also, what kind of ROC would this business do on an annualized basis?
Gosh, ATC, we are, what can I say? We are very, very optimistic that it should start making some money from this quarter, which is Q4 of FY22. As we've announced before, we've also done some amount of expansion in ATC, where we've signed up another beverage company to expand the capacity there. Given my 2 years of missed targets as far as ATC is concerned, I really don't want to go out on a limb and say anything in terms of tangible numbers and ROCs that we can get from ATC. I can just reiterate certain reasons why ATC was a very attractive acquisition for us. It has a carry forward loss which is quite significant and should help us save some taxes now that the merger is done. It has a capacity of doing close to nearly 200 KL per day as far as beverages is concerned, both carbonated and non-carbonated. It has around 16 acres of land, which we are now expanding with one more factory in terms of expanding the capacity. If all of these come true, I am hoping that the ROC will be quite interesting in the next year or so. Yeah, Akash.
Sorry to interrupt. May I request Mr. Akash to please rejoin the queue? We have participants waiting for the turn.
Yeah, so sorry. I'll come back. Yeah, thank you.
Thank you. The next question is from the line of Akhil from Centrum. Please go ahead.
Hi, Samir and team. Many congratulations on the very good set of numbers. Samir, my first question is on the operating leverage part. And
may I request you, Mr. Akhil, to please speak a bit louder?
So, is it better now?
Yes, please go ahead.
Yeah. Samir, my first question is on the operating leverage of the business. If you look at it, like we have scaled up significantly over the last 3 years. Our sales have gone almost fourfold from 500 CR to 2,000 CR. Do we see any scope in terms of margin improvement going forward, or should we still expect that the margins to hover around at 67% once we kind of reach 4,000 crore of a time?
Okay, hi Akhil. Akhil, we basically, this goes back to a very basic fundamental level question, which is about our business models. If you look at the dedicated manufacturing model that we offer to our customers, in this case, frankly, operating leverage does not come to us. So we don't benefit from operating leverage because it's a take-or-pay contract which assumes that we will reach optimal capacity utilization within the first 3 to 6 months. And as a result, the operating leverage actually does not make any difference. However, you are right that there will be some amount of financial leverage, especially in case of the EBITDA levels, where you're talking about the depreciation and the interest. And as we grow larger and as we have more internal accruals, we'll definitely see some margin improvements as far as the financial leverage is concerned. More in terms of Mayank can elaborate, but we've been able to get better rates on our loans, etc. as well, just because the sheer size and the scale of the company has increased. When you look at our anchor tenant model and the shared facilities, there's a huge amount of operating leverage there. And like the previous gentleman was asking, we actually have a lot of operating leverage in case of those facilities. This includes our facility for ATC, which was what Akash was asking about. We have a huge amount of operating leverage there. The current acquisition in Chennai, which is the shawl factory, has a huge amount of free capacity headroom, which we should be able to leverage in case we are able to consolidate the business of Dr. Shawl and Shawl. So these will, going ahead, hopefully better our margin profile. But like I said, actually what I can say is this is as bad as it can get. It can only get better from here.
Okay.
So we don't expect that the margin profile will deteriorate because that's contracted. Any kind of improvement because of other things that I spoke about can only go upwards from here.
But a mix will largely remain same, right? In terms of contribution from dedicated manufacturing over next 2 to 3 years, which I think is around 85%, should largely be at that level, right?
Yeah, Akhil, hi. So yes, you are correct that this year and next year, at least up to next year, the mix will remain same.
Okay. And the second question is on the AeroCare acquisition. In the presentation, I see that the plant is just 1 year old. What made the company sell it, given that it's just 1 year old plant?
I'm sorry, Akhil, we couldn't hear you very well.
Yeah, I'll repeat my question. I'm saying on the AeroCare deal, the plant is just 1 year old, right? So what made the sellers sell the plant basically, given that it was just 1 year old?
Akhil, I obviously don't want to comment on a specific decision by a promoter, but let me just talk about the overall trends, right? And we've discussed this earlier as well, that there is some amount of consolidation that is happening in our industry, which is the contract manufacturing of FMCG industry. The consolidation is happening for various reasons, which include, just the fact that scale is becoming much larger. So a lot of smaller players are not able to end up scaling as much as their customers want. The cost of compliance has increased substantially, and I just don't mean statutory compliances in terms of GST, taxation, etc., but also social compliances in terms of workers, environment, health, safety, etc. These are some of the reasons why we are finding very good opportunities to be able to consolidate this business. And we are able to acquire some assets. And that's one of the reasons why I said that M&A has been a very integral part for the growth of HFL. And we are hopeful that this will continue. The third reason for M&A, of course, is divestment, which is what our other acquisition, which was Reckitt Benckiser Scholl, is, where some of our principals, in order to make their balance sheets asset-light, look at divesting their assets in favor of someone like us, who is keen and interested in having a very heavy asset book. So as a result, Akhil, without getting into the specifics of AeroCare or Shawl, these are 2 or 3 reasons why we believe that there will continue to be a consolidation and a huge amount of or a large number of acquisition opportunities for the next couple of years.
Sure. This is helpful. Just one last bookkeeping question.
Akhil, I'm sorry, you need to speak a little louder, yeah?
Yeah. Just one bookkeeping question, Samir. You mentioned that next year we should clock around 3,000 crore of a top line, right? So is it the visibility we have, or is it something we are guiding for 3,000 crore of a top line?
That is not bookkeeping, yeah. I was all ready to ask Mayank to answer this question. He's looking at me and saying that I will have to take this call. It's not plain vanilla bookkeeping. But so on a serious note, Akhil, what we've done is, if you see our last quarter's performance, we are at around 520 odd crores. which if I extrapolate it just at the same level, 500 into 4 is around 2,000 crores. We have announced the acquisition of these two factories, which is going to contribute around 100 crores per annum. So that should take us to 2,200. We have an ice cream factory which should start producing at its optimal level by May, latest June. In addition to that, we have a Hyderabad project which has been delayed, but we are hoping that we'll be able to start that at some time during the course of next year. So that should give you a broad idea of our journey from 2,000 to 3,000.
Sure, got it. This is very clear, and wishing you all the best for coming call.
Thank you so much.
Thank you. Participants, to ask a question, please enter star and 1. The next question is from the line of Akshay Jain from Jain Capital. Please go ahead.
Hi, good evening. I have a couple of questions. Firstly, have you witnessed any change in customer contracts in last 2-3 quarters, considering the sluggishness in FMCG demand from rural areas and also some protests from FMCG distributors in some areas?
Akshay, that's the only question?
No, I have another question.
Okay, so but let me address that anyways, okay? So Akshay, yes, there's definitely been some amount of pessimism as far as capacity expansion is concerned, which is a direct result of the fact that the rural economy and the economy in general is not at the level at which we all would like. Having said that, in case of FMCG being a defensive and being a consumption-driven story, we continue to see capex happening in spite of the overall pessimism. So to give you a simple one-line answer, capex continues. We are expanding. However, the pace of the capex and the pace of the discussions with our customers has definitely slowed down in the last couple of quarters, for sure.
Okay. Secondly, have the increase in input costs been passed completely to the customers during the quarter, or we have witnessed any impact on margins because of the cost rise?
Okay, I'm going to let Mayank answer this.
So Ashok, hi. So as per our contract, we are passing all the increase in the input cost to the customers, but there will be some time lag if we say quarter to quarter, because it takes time to get the approval and get it into the system. But as per the contract, we are passing on all the input cost increase to our customers.
Sure. That's all from my end. Thank you.
Thank you. The next question is from the line of Shrish Vaju from Money Life Advisory. Please go ahead.
Hello. Thank you for giving me the opportunity. My question is regarding the arrangement that we have in our dedicated units models. So by looking at the credit rating report, I understood that the debt service also for setting up or acquiring these plants is guaranteed by the client. So my question is, how does this arrangement work in practice? Like, is it that if for some reason the company is not able to pay its debt service, then the client will kind of come in and kind of foot the bill?
So Shirish, Mayank here. So Shirish, that is guaranteed not directly but by indirectly, where the contract says that in case of termination, the customer will pay the debt on the books to us. It is us who will pay to the bank. So it is the indirect arrangement. The customer cannot give the will not give the direct comfort letter to our bankers.
Okay. Understood. My follow-on question would be like when we are kind of trying.
May I interrupt?
Yeah.
Okay, so I think Mayank became a little too technical on the whole thing. I think the question that you asked is what happens in terms of the pass-through mechanism.
Yeah.
And the pass-through mechanism is very, very clear. Like Mayank was saying, it's the same principle like for other expenses. In case there are interest rate variations, in case there are changes in the interest rates, etc., our capital servicing cost changes There could be a time lag in that change between us and the customer, but principally it changes the minute there's a change.
Got it. Thanks. So my follow-on question is when we are kind of trying to acquire a newer unit, or we are trying to build a newer unit in this dedicated unit model, is there a kind of typical debt to equity ratio that we target for these kind of acquisitions or developments?
So our current debt to equity ratio is below 1, right? Our the contracted debt to ratio with our customer is much higher, but based on the corporate cash flows and all, we try to optimize our debt to equity ratio. But we are very comfortable right now, and we see that even if we do take some debt, we will be in the comfortable position next year also after all these acquisitions.
Got it.
And in terms of the capital allocation policy, Shirish, if it's a dedicated factory, we are very, very happy to take on debt, which could be in the debt equity ratio of 2:1 or even higher. In case of shared facilities, we are far more conservative, and depending on the quality of the business, we might actually take on zero debt for shared facilities. So in terms of the capital allocation policy, the debt, taking on the debt depends on the nature of the business, it depends on the nature of our contract with them, and it also depends on the counterparty risk of our customer.
Got it. Thanks for that. That would be all from my side.
Thank you, Shirish.
Thank you. The next question is from the line of Keshav from Raxin Investors. Please go ahead.
Hi, good evening, sir. So my first question is very broad-based. So we've had in our portfolio detergents, mosquito repellents, some extruded goods, beverages. We're pouring into ice creams, cosmetics. You mentioned nutraceuticals as well in your AGM. So could you help understand where our competencies lie? As in, is it manufacturing? Is it management? What is in our DNA that speaks out that what we do and what we can do, more importantly? So why I ask this is, now that we've had experience in manufacturing for so many years and so many things, we gain the expertise to be better equipped in the future to probably go for more private label opportunities and later on maybe CRO work. So I mean, for that we need a deep know-how of not just the manufacturing bit but also the product development. So it would be awesome if you could shine some light on this. There could be a lot of opportunities coming in the B2C space in the near and the medium term, please.
Keshav, hi, this is Sameer. So Keshav, you're absolutely right on a couple of points, and this might take a couple of minutes for me to elaborate on. One, you rightly identified that private labeling, white labeling is going to be increasing. If you've been following the company, we actually set up a division to cater specifically to the private labeling and white labeling needs of retail players, e-commerce players, etc. Having said that, the private labeling, white labeling currently is at a level where the so-called domain knowledge or R&D expertise that is required is at a very basic level, which we currently have. Which then brings us to the point that what do we actually have, right? What do we bring to the table when we manufacture something as diverse as pest control to infant food formula and to ice cream? So from food to things that can kill you. What we bring to the table is our ability to execute. I think in this current new age phenomena, I think a lot of discussion happens around ideation, a lot of discussion happens about marketing, branding. But people tend to forget that there's a lot of execution that is required to be able to do something successfully. And our expertise is that we are, and like we said it in our annual report as well, we are the brawn behind the brand. So we are the guys who actually go and execute projects. We have expertise in terms of project management. We believe we have expertise in terms of manufacturing, going and dealing with, let's say, 5,000 workers across the country, going to be able to deal with the ground level situation in 11 states across close to 20 factories spread across these 11 states. That's what we bring to the table. Now, if for a minute I will get onto my soapbox and try to tell you what's going to happen 5 years from now, 5 years from now is exactly what you are saying, that we will need to develop domain expertise for each category. And the way we are looking at our category is very similar to what a lot of the FMCG companies look at, which is we are saying we are into home care, we are into personal care, and we are into foods, right? So what we're going to do is at some point of time, we will need to develop and maybe even split the company into these three divisions, which is home care, personal care, and foods. Then tie up strategically with people who bring in the domain knowledge and the expertise to be able to do far more value-added R&D, what we like to call contract research, at that time. However, that's at least 5 years away, Keshav, from our evolution.
Sure. So, sir, like second point to that, so we now are pouring into nutraceuticals and cosmetics part. So, is this a starting point to get comfortable with these kinds of products, and because that will only enable what you want to do 5 years from now, right?
I'm not sure I understand the question.
So, it's a new category. For example, say cosmetics. So is this a starting point to get comfortable with this category in general, so that 5 years from now we are better equipped to maybe go for the private label or CRO work if that kind of work starts happening in India?
Absolutely, Keshav. I mean, any of our acquisitions, if you look at it, when we acquired the shoe business, we actually were not doing leather, and we now think we do understand leather and shoe production a little bit. When we acquired ATC Beverages, we were not doing any beverage filling, and we believe that we've now finally understood how the beverage industry works. Similarly, for color cosmetics and for OTC healthcare, we do look at acquisitions as a way of going up the learning curve quickly in terms of getting into that sector, understanding that sector, and then hopefully based on that learning, based on that organizational strength, we will then be able to expand further within that sector. So yeah, absolutely. I mean, to give you a short answer, you are absolutely right.
Awesome. So also these, after our foray into healthcare and cosmetics, have our addressable market also expanded beyond the figures we mentioned in the past?
The addressable market that we had mentioned earlier basically took into consideration the entire definition of FMCG. I would say the addressable market has extended or increased or expanded because of our recent expansion into healthcare and OTC products. So color cosmetics, I would say, for one, it's a very, very small part of FMCG. And I would think that it would already be counted as a part of the FMCG universe. However, OTC healthcare, that's a large business, and our acquisition of Shawl and any other things that we look at within that space will hopefully increase our TAM as far as our manufacturing business is concerned.
So, and sir, another, it's probably a long shot, but I've been reading that there's potentially going to be quite some demand and supply difference in the plant protein category, and it will be a multi-year trend with a very large market to tap. And I understand that you need extrusion lines to make these products. So considering that we have had experience making extrusion goods, is this a space we are monitoring, or whether these competencies of having handled extruded goods are significant enough from a barrier point of view for anybody to step into? I mean, if we'd have an edge if we decided to go for it, or is it too naive on my part to assume so?
Keshav, you're bang on when we all are as optimistic as anyone else on the growth of for meat or plant-based meat products are concerned. You're absolutely again right that the extrusion facilities that we have will be able to service this demand. However, in spite of all the optimism and the hype around the sector, right now the sector is extremely small. The factories that we have are capable of doing around 6,000 tons of extrusion, and I would hesitate to put a number of total demand in the country right now. But in the long run, and I'm not sure. And that's probably me, right? It's my personal opinion. I'm not sure whether for meat and plant-based meats will see the same amount of traction it will in India as compared to the rest of the world. If you look at the food habits and if you look at the Indian demographic conditions, we are far lower in terms of protein consumption right now. So I think we still have a lot of space just from a population expansion perspective for growth in poultry, growth in meat, growth in eggs, etc., before people start looking at substitutes for that. But anyways, that's a different discussion, and I probably shouldn't get onto it. I'm sure everybody in the room is already kicking me under the table.
So if I can ask one quick question. The rackets OTC business, does it qualify as pharmaceutical or is it a nutraceutical?
It actually is a pharmaceutical. These are bandages. These are foot care products. If you're familiar with the Shawl brand, these are medical bandages which are required for corn caps, required of various foot care products, including orthopedic insoles, creams, lotions, gels, basically for foot care and foot comfort.
Okay, so we'd have to go through the
we have to go through the FDA and
regulations.
Absolutely. So, which is why it is approved by MHRA, and we are currently this factory is currently exporting to nearly 30 countries in Europe as well as Australia and New Zealand.
Okay, all right, sir. That's all from me, sir. All the best. Thank you.
Thank you. The next question is from the line of Neha Parekh from Raga Securities. Please go ahead.
Good evening, sir. Sir, I have a couple of questions. Firstly, I would want to understand, what are the risks do you see that the company may face in terms of not achieving this 4,000 crore revenue target in next 3 years? As there are 4 to 5 projects which are running simultaneously. So can there be any change in this revenue target if the company faces any delay in the commissioning of the plant?
Neha, I was hoping you'll ask us for an upside risk rather than a downside risk, yeah. But so since you've asked, I'll talk about both the upside risk as well as the downside risk, right? So from an upside risk, from a downside risk, I've actually kind of in response to some question earlier, I kind of laid out our journey from 2,000 to 3,000 crores, which should practically happen in the next financial year itself. And going from 3,000 crores to 4,000 crores in the next 2 years, which is FY24 and 25 based on our current timetables. The downside risk is basically that of execution, right? And I think that's got to do more with like I said earlier, our skill set in managing projects, our skill set in going to various locations, setting up factories, running factories, etc. I do not see any strategic or macro risk from a company perspective. Now, there of course is this overarching macro environment risk, which is that will FMCG sales suddenly drop? Will the economy not grow in the next couple of years? And all of that, which I don't see the time or the reason to get into. So from a downside risk, I think we are reasonably confident that we should be able to get to 4,000 crores by the time that we've mentioned. In terms of the upside risk, we are hoping that we'll get them sooner than later.
Okay. So my second question is, if you can please share the product range that the company will be manufacturing at the acquired unit of Reckitt, I'm sure, at Chennai, and will all these products will be exported or would the products be for the domestic market also?
Okay, so in terms of the product range I just mentioned, they are all foot care and foot comfort products. If you've ever used corn caps, these are basically when you get corn on your feet or your toes, etc., you use corn caps. Similarly, something which will probably be more familiar to you, we make a product which is for party feet, for women who basically wear high heels and have to deal with discomfort and shoe bites because of their stilettos. So products like this. Then we make products for runners which include gel bandages, etc. This is the entire range of Shawl and Dr. Shawl. Frankly, the brands have been around for a very long time. They have a long heritage. What has happened is that these brands have now been acquired by an American company called Shaw Wellness, as opposed to them being a smaller part of larger pharmaceutical companies like Bayer and Reckitt Benckiser. And as a result, we hope that you'll start seeing a lot more of these brands than you've been earlier seeing. Currently, this factory is 100% EOU, which means we do export pretty much more than 90% of what we manufacture at this factory. We are hoping that the new company which has acquired both of these brands has a very robust plan for India as well. And when they start rolling out that plan, we are hoping that we'll be a major player and a business partner for that plan.
Okay, this is very helpful. Thank you so much.
Pleasure.
Thank you. The next question is from the line of Akash Zaveri from Perpetual Investment Advisors. Please go ahead.
Hi, Mr. Kothari, and firstly, thank you so much for answering all my questions, so patiently. Just a couple of more questions. One was, what would be the any update on the shared personal care facility at ATC Beverages? The next one is, how does the current deal pipeline look? Like, are we working on any further dedicated plans? And my last question for the day would be, earlier, what I asked you about the 100 crore guidance which you gave for FY23, is that 100 crore just for the 50% of the Scholl business, or would it be even for the other 50% where we're still looking for new tenants in the anchor tenant model? That would be all for the day. Thank you so much.
Hi, Akash. Akash, ATC personal care facility, the civil infrastructure is ready. We, however, are in the middle of a discussion where instead of personal care, we might be converting that facility into a beverage facility. I do not have any details to give to you now. Maybe in the next quarterly meeting, I should be able to tell you a little bit more in detail about what the current discussions are. Like I've kept mentioning about ATC, we are hoping that this beverage season, after nearly 2 years of a washed out season, is a good season for all the beverage players. And as a result, we believe that there might be a major capacity expansion which might come in ATC, in which case we might not go in for the shared facility of personal care that we were earlier looking at. The idea of the shared facility, if you just go back to our earlier calls, was to build a hedge for the beverage business, especially since the beverage business was not doing well. Since that has changed, I think we'll probably go with the flow and continue to expand in beverages. That's one part. The second part was about the deal pipeline. I unfortunately, Akash, cannot give you any details about the discussions that we are having other than the ones that we have announced. All I can say is the team as well as I are constantly looking out for new customers, new projects. And in spite of the current, let's say, slowdown or the current hesitation in terms of capex, we continue to see in FMCG a robust demand, and a lot of our players are looking for the long haul, where they're looking at demand 6 months down the road rather than reacting to demand every quarter to quarter. So our deal pipeline, though slowed down as compared to 6 months ago, is not dry. That's all I can tell you.
Sure, thank you so much. And the last question was about the Scholl 100 crore. If you could just tell me if that is 50% or the whole.
So Akash, I did try to answer that question. So what I said was that the current guidance that we've given for that facility is based on the visibility of the business that we currently have. The visibility in terms of the expansion because of other customers coming in, or because of the increased wallet share of the existing customer, we do not have that visibility, and as a result, we've not built that into the guidance.
Got it. So if at all that happens, it's just a bonus for the facility?
In so many words, yes, Akash.
Yeah, got it. Thank you so much for answering all my questions, and all the best for the current quarter and the next year. Thank you so much.
Thank you, Akash.
Thank you. As this was the last question for today, I now hand the conference over to Mr. Vimal Solanki, Head Emerging Business and Corporate Communications, for closing comments.
Thank you, Rutuja. Ladies and gentlemen, I take this opportunity to thank everyone for joining on this call. We're pleased with HFL's operational and financial performance for the 9 months of this year. It has been in line with the company's targets, and we are on track to meet our medium-term and long-term goals. We continue to believe that there is an enormous underlying opportunity in the FMCG contract manufacturing space, and we remain focused on accelerating growth through our strong CapEx plans and capturing the larger pie of this opportunity. With new acquisitions that we discussed earlier and the organic growth from our existing factories, we are confident of achieving the target of rupees 4,000 crores of turnover by FY 2025. Thank you again for taking out time today. I hope we have been able to address all your queries. For any further information, kindly get in touch with us or SGA, our investor relations advisors. Here's wishing everyone a warm and tender Valentine's Day evening. Stay healthy, stay safe. Thank you so much.
Thank you. On behalf of Hindustan Foods Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.